you doing? How you doing this morning? We got a lot to do today. We're going to compare options to our portfolio of dividends. All right. Now, we don't do traditional dividends. We do weird ones. All right. Weird dividends. What are weird dividends? Well, we do the new yield max fund dividends, one that have high returns. So I think it's important to distinguish between the two because the yield max funds are not traditional dividends, right? What are dividends? Well, dividends are money that the companies give you as profit sharing. And so that's a traditional dividend. And I think we should go look at a couple of traditional dividends so that we can compare them to the yield max funds. So we're going to go look at AT&T. AT&T is one of the companies that gives the best dividends ever. They're one of the tops. Now, they're not always the very top, but they're one of the very best. They give you great dividends, all right? So we're going to come in here, and I'm going to pull up the dividend version of this thing. We're going to come over here, and we're going to pull up T for AT&T, and I'm going to make myself down here this time, make this a little bigger for you. All right, so this is AT&T, and this is how often they give you dividends. Every 3 months, you can see they give you a dividend, okay? So we're going to do a little math here. So get out your paper and pencil. You got a paper and pencil? I'll grab my paper and pencil, and we will do a little math. All right, you got to do math when you do dividends. So what we're going to do is we're going to look at how big the shares are at $27. So they're trading at $27. Let's say $27.50. So that's $27.50 each on the share price. Now, every 3 months, they give you a dividend of 27.27.278, all right, based on the number of shares you have. So let's come in here, and for AT&T, we're going to put $100,000 into AT&T. So write that down on your little piece of paper, $100,000, and we're going to pull up our little calculator. Now, this is how you do the math, all right, and get your little calculator out. And we're going to say, okay, here's what we're going to do. If I have $100,000, how many shares can I have? Well, I'm going to take 100. 1, 2, 3. So I got $100,000, and I'm going to divide it by, we said 2750, 27.50. So that gives us 3,636 shares, right? All right, so you got that down on your little piece of paper. So now what we do is we now take that number right there that says 27 cents, 278. Let's just call it 28 cents. All right, we'll call it 28 cents. So we're going to go times 0.28 equals. That's 1,018.18. That's $1,000 every 3 months that you're going to get off of your $100,000 investment. That's pretty cool, right? They're just going to give it to you for free. Here's some free money. Here's an extra $1,000 every 3 months on your $100,000. Now, let's say that we want to live off that. So we have to divide it because we need to have that every month, right? So we're going to divide that by, we're going to multiply it by 4 because we get 4 of those a year. So we're going to take that times that by 4. And that gives us $4,072.72. $4,072 a year. Now we're going to divide that by 12 because we got to live off of it. It ends up being $339.39 a month. Oh my gosh, that's a lot of money, right? I mean, we're going to get rich, rich, rich beyond our wildest dreams with our AT&T dividends. $339. All right, $339 a month on a $100,000 investment. We're going to get rich. All we have to do is have $3 million and we can retire on our dividends. Okay, good deal. Now, let's go over to a different kind of fund, a weird one, all right? A weird one. Let's go do a weird one. What's a fun weird one? Let's just go over, and we're going to do one called MAGS, M-A-G-S, and we're going to see how it compares, all right? MAGS, not MAGS, sorry, YMAG. YMAG. Now this is not an individual stock like AT&T is. This is a fund. All right. So this has 7 stocks in it, and 7 stocks who all give you weird, this fund gives you weird dividends. All right. So we're going to go look at this one first. So here it is, YMAG. Now it pays you every week, not every 3 months. So that's pretty cool too, right? Now, for some reason, this company, Little FinViz, has stopped giving us the numbers. I don't know why. They have lost connection to their data service or something, but they haven't given us the last few numbers. So that's okay. We'll just use an average. We got to use an average because they have it looks like the average is about 9. So we got 9.7 here. We got 9.7 here. We got 8.4 here. It changed a little bit, 8.5 here. So let's just say 9. Let's just go with 9 cents. And you're like, oh, that's not nearly as good. We're not going to make nearly as much money on this weird one that Land's talking about, right? We're not going to make nearly as much money on Land's weird one because it's only 9 cents. Well, AT&T was paying us. How much was AT&T paying us? They were paying us 27 cents. So Land's little idea here is probably going to come back and smack him in the face. Bad example. Let's try it, though. Let's go see what happens. Because if they're going to give us 9 cents every week on our shares, all right? So first of all, we're going to take our $100,000. Write that down, $100,000 on your little piece of paper. And if we have $100,000, how much are the shares? They're $14.41. Let's just go 14. Let's go 14, 43, 4, 5, 6, 43, 4, 5. Let's go just go 14.45. 14.45 shares, share price. All right, so write that down. So we're going to take $100,000. We're going to divide it by 14.45, 14.45. So we can see how many shares we get. We get 6,920 shares. All right, 6,920 shares. So 6,920 shares. Now what are we going to do? Now we're going to go through and we're going to say, I'm getting, what did we decide that was? 9 cents. So we're going to get 9 cents per share every week. So we're going to go 6,920 times 0.09 equals, we're going to get what? $622.80 a week? Does that make sense? $100,000 divided by 1440 is 6,920 shares. And it's $622 a week. And there's 52 weeks in the year times 52. Oh my hell, that's $32,385.60. I guess it didn't backfire on Land. So AT&T, one of the highest dividend paying stocks, which is traditional dividends, pays us $339 a month on our $100,000 investment in their dividends. And YMAG, because it pays us 9 cents on every share and they pay it every week, we get $32,385 on our $100,000. I could almost live on that in retirement because you're going to supplement your Social Security with that, right? $32,000 a month. Let's go $32,000 a month divided by 12. $2,698 a month. $2,698 a month. I was getting $339 a month from AT&T. $32,000 a year from 239 3. Oh my hell! $2,698 a month. Now let's say that I get $2,000 in Social Security. $2,000 in Social Security, and my wife gets $1,000 in Social Security. If I add those up, 2, 4, 5, $5,698 a month. I think to retire, all you'd need to have is $100,000 and put it into YMAC and supplement your Social Security. You could have $5,698 a month in retirement. Du. I want more money, Lynn. You want more than that? You want more money than that? On your $100,000, you want more money than that? Don't say it. All right, let's go look and see if there's not something with more money. Okay, let's go look at PLTR, Palantir. Palantir is an up-and-coming company. It just got added to the S&P 500. If you go to Palantir, oh, sad days, Palantir. They don't give dividends. Oh, that's sad. Palantir doesn't give dividends. So what are we going to do? Well, we could trade options on it. Land talks about trading options. And I did say out on the little marquee, right? Out on the little thumbnail, dividends versus options. Maybe we should talk about options on Palantir. Or we could just say, no, I'm lazy. I don't want to trade options, Land. Just give me my free dividends. Just give me my free money. Okay, well, Palantir doesn't give free money. But you know what? PLTY does. PLTY is a Palantir version that gives you dividends. Oh my gosh, look at that. It's Palantir right there. Yield Max PLTR options income strategy. Now it's based on options, PLTY, but it's a single stock this time. It's not a fund like the Magnificent Seven, like MAGs, YMAG, which is Apple, Amazon, Netflix, Google, Tesla, Meta, one more, NVIDIA? I can't remember. All right. So there you go. Let's go do our math on PLTY. You guys got your little math fingers out? Get your piece of paper. We're going to take our original $100,000. $100,000. All right. And clear out our calculator. How come it's not clearing for me? Clear. All right. $100,000. Now what we're going to do is it's $63.35. Let's just say 60. We got to take our $100,000. 100, 1, 2, 3, divided by 63.34, 63.34. That gives us 63.34 is the share price. That gives us 1,578 shares and 78 cents. Now, we don't need 78 cents. So 1,578 shares. Now remember, they pay you your dividends based on the number of shares you have, not how much you paid for them. So it's how much you pay, how many shares you have. So now let's go and look and see how much they're paying out per share. And we click on that. Oh, $5.32. $5.32 per share. We have 1,578 shares because we have $100,000 in PLTY. We're going to go ahead and we're going to go 1,578 times 0.532. No, it's not a point. This is times 5.32. So you're going to take your 1,578 shares and multiply it by $5.32. And we're going to hit equals on that. That's $8,399.11 a month. What? They're going to give me $8,399 a month for my $100,000 on PLTY? That's my dividends, $8,399. Oh my hell. Multiply that times that by 12. That's $100,000. If I have $100,000 in Palantir, PLTY, at the end of the year, they're going to give me $100,000. Oh, I don't even need my Social Security on that one. $8,000 a month. Are you kidding me? I think I could retire right now. Why don't you? That's what I do. I just trade for a living. I sold my businesses. I don't have anything else to do. Sit around here and do YouTube videos with you guys and show you what I do. I'm not telling you what to do. I don't really care what you do. You do what you want. And I'm not telling you what to do. I'm just telling you what I do. All right. Now, I like to trade options still. I used to trade options a lot. I used to do this myself, right? Try to build this type of a portfolio model for myself out of options. But these guys are such good options traders. I was just like, well, I don't do a whole lot of options anymore. I still do. I still think it's fun. I like to do them. I still have a good little options portfolio. And but I like to teach options too. I like to teach at the university, so I still teach at the university, and we do fun things. But yeah, I have more than $100,000 in Palantir. Well, no, actually, that's about all I have in Palantir. But I have about 10 of these things, and there's more than just one. There's more than PLTY. Let's go look at another one. I have about 10 of them. I have about $100,000 in 10 of these things. Now, they don't all pay as high as PLTY, but that's okay, right? I mean, you don't want to put all your eggs in one basket. If you're small, you can. Nothing wrong with that. You can just concentrate on one thing and just do it well, right? But if you want to diversify a little, here's another one. TSLY. Tesla. You could go put some in Tesla. Let's go look at TSLA. This is the one everybody trades, right? Well, Tesla doesn't have any dividends either. What the hell is wrong with Tesla? No dividends. Oh, no, no dividends on Tesla. Okay, well, go over to TSLY then. TSLY, and it'll do dividends for you. And how much is it going to give you? Well, if you put $100,000 in here, look, Tesla's trading right now at $8, and they give you $4, almost $5 a share. They're going to give you a lot of money. You want to do the math on one more? Well, we'll do the math on one more just for fun, just for kicks and varieties. All right, we'll take our $100,000, 1, 2, 3, divide it by what's it trading at? 18, let's say 1820 or 820, 8.20. So that gives us 12,195 shares. 12,195 shares. So we're going to take that times that by 46 cents, 0.46. That's $5,609. $5,609 a month times 12. That gives us $67,317 a month. Oh my hell, that's a lot of money on a $100,000 investment. Man, it seems too good to be true. Is it dangerous? I don't know. What part of the stock market isn't dangerous? I mean, it's always dangerous. Markets go down, you lose money. That's the name of the game, right? I mean, these are long positions. Market goes down, you lose money. And market's been going down lately, right? Market's been going down, down, down. But what if the market stopped going down, started going up? I hate this little piece of software. Come on, let's go over to Track and Trade where we can draw things and do stuff. All right, where's it at? Here it is. Okay, so let's go into TSLY. All right, so what if the market started to go down? Look at this, 3-drive pattern, drive 1, drive 2, drive 3. Well, they're going to pay you your dividends all the way down, all right? And your share prices are going to kind of go down too. But it's going to keep paying you your money. Now, it's going to pay you less, but that's 3 drives down, and we kind of expect this market to rebound and start to go back up, right? It's going down today, but that's kind of normal. That's not freaking us out at all, right? If we go into PLTY, well, we're going to go into PLTR because we look at the PLTR and we trade the PLTY. Okay, PLTY is the underlying stock that is the one that we trade, but we don't trade that. We watch this one. All right, so we watch this one. So we come in here and see this. Made a nice little ABC pattern here. ABC, ABC, just like that. We're going to do a different tool. We're going to use this one here because this one's got math on it. All right, so we're going to come in here, A, B, C, and we're hitting that 90%. What do I always tell you? Markets don't always like to go and do 100% of everything you expect them to do. They're kind of lazy. Markets are lazy. So they come in here and they go to 90%. That's why that 90% is in there, because sometimes markets get lazy and they don't all go all the way up to 100%. We would like them to go all the way to 100%, but they don't. And why is that? Why do markets sometimes stop at 90%? Well, I got some theories. And here's one of them. And I don't know how valid this theory is, but see that little bottoming tail down there? See that little tail right there on this bar that we went and put our A on? See that little bar? See how it's got a body and a tail? Little bottoming tail. Let's. There you go. Nice and big. Come on. Come on, land. See that nice big tail right there? Can you see it? It's a tail, bottoming tail. Well, I put that on the bottom tail. Now, when I was in Chicago at the Board of Trade, and I was watching the experts do this stuff with their mathematical modeling, they used that bottom tail just like I did right there. And it's really hard for me to not do that because that's the way I was trained. I was taught. I was taught by the best. All right. The very best of the best. I went to the Temple of Finance in Chicago at the Board of Trade, and I took classes there. And that's how they did it. All right. At the Temple. So I have a real hard time saying, let's not do it that way. But I've noticed that markets have a tendency sometimes to go to 90% and not to 100. And I wonder why. And so what I do is I say, well, I think it's that little bottoming tail right there. I think there are people in this world who don't know you're supposed to put it down here. And they put it up there. And so because they put it up there, up here, it goes to 100%. And they say, see, it went to 100%. That's because they discount that bottoming tail. They pretend that price didn't ever go there, but price actually did go there. So I was taught you're supposed to take that into consideration. Consider all price. All right. Not just the open, high, low, close, not just the high and not just the open and not just the close, but the high and the low as well are important. But I think there's a lot of guys. And how do I know that? Because I've seen other guys on YouTube channels who are dumb guys who don't know what they're doing, who don't take those tells into consideration. Well, the problem is you have to consider that there's dumb people in the world who are going to do that. And because there's enough dumb people in the world and they discount that little tail down there, that brings our 100% right up here to, they can say, oh, it went to 100%. No, it didn't. Because you didn't take the tail into consideration. It went to 90%. That's why I have to put that 90% in there. Because there's dumb people in the world who do the same thing that I do, and they discount the price that's down here, this little tail. All right. So you say, well, Lan, why do you do these weird little things? Well, it's because we have weird people who have learned this stuff, and then they do it weird, and it screws things up. So there you go. That's how come we put 90% in there. Now, I could do the same thing that they do. I could break the rules, right? I could break the rules and put that there, then I wouldn't need my 90%. But if I broke the rules, then I would be stupid too. I'd be one of those dumb guys on YouTube that does it wrong. So instead of doing it wrong, I have to make adjustments for the dumb guys. That's why I put 90% in there. Markets oftentimes will only go to 90% because dumb guys will discount that tail right there. They knock that tail off. And sometimes they'll knock this tail off. All right. They'll knock that tail off and they'll knock this tail off. And they'll knock this tail off. And then they do it like that. And then like, see, I went right to 100%. But they're knocking off all the tails. Well, if we turn off the Heikin-Ashi, those tails are gone, right? Then we're going to go like this, and we go like this, and we go like this, and then you end up with it at 90% anyway. Who knows? Who knows? Nobody knows. It just goes to 90% a lot of the time. It just depends on how you want to do it. Markets are lazy. That's what I say. Markets are lazy. All right. So who knows? Sometimes they go to 90%, but then they start to flush back. All right. So here we are. Now, one of the things we're looking at is we want to count this. Like we come in here and look at these little breaks in here. Okay. We're getting another little break in here. So if we count this first break right here for this coming down, the natural trend line. All right. You have to go to the natural trend line just like that. So the natural trend line, the first break of the natural trend line, then we have the mathematical trend line break, and then we have the horizontal, right? So that's the spider web. So if you want to, that's what I call it. I call it the spider web. So spider web is this little thing right here where you get little three little patterns like that. If you want to talk about the here, look, let me show you something. Let's be official, all right? Like we're in the temple and we're doing our temple work. If you want to do your temple work and you do it perfectly right and you don't call it spider web, then you call it speed fan. All right. So speed fan is this tool right here in the software. So you go one, then you go mathematically modeled. There's your next trend line. And then the horizontal is the third one. And that's your speed fan. Okay. It's called speed fan. I call it spider web. Why? Because it's more fun. You'll remember spider web. You'll forget speed fan. Okay. Speed fan's no fun. That's the real word for it. That's the one they're going to use if you're in the temple. But I don't like to always call it speed fan. I like to call it something else. Looks like a spider web to me because it goes between all of the different ups and downs. And if you look at it on a long-term basis and you look at a big long trend, it's got three little speed fans in there. It looks like somebody's gone in and put spider webs in it. It's kind of why I call it spider webs. All right. So again, you'll remember spider webs. You'll forget speed fans. Okay. So there you go. So if we come in and we do that, and that one that's the most important is that first natural trend line right there. Okay. So we're going to count that. We're going to come in and we're going to say this market's going to have the probabilities in here. We're going to count the probability. So that's going to be, we're going to call that A1. All right. So that's our first entry on our first drive. So this is drive one right here. How do we know it's drive one? It's actually the first drive or the A drive because see those blue lights right there? They haven't broke yet. So that's all one big long drive. Until they break, it's just one drive. So see this coming down from this top to this bottom. That's one drive. Why? Because the blue lights, mathematically calculated trend line, they haven't broke, right? So if you draw your natural trend line, you come in here and you say, I'm going to draw my natural trend line like this. Then what happens? Well, it gets broken right there, but then it continues down right here. And then it kind of breaks right there. And then you get higher highs. And then that's where your magic, that's why you have to have the blue lines in there, which are mathematically calculated. So you know where your first drive is because it might round out on the bottom, give you a little head and shoulders formation like this on the bottom side here. And then it breaks and it takes off and goes once again, right? So that's how that pattern works. It's one drive, however you want to count it. It's just one drive. And so we have all these little trend lines in there. So you have to count those little trend lines because they're important. Don't forget that they're important because they're part of your count and measure. So we're going to come in here and we're going to call that A1. This is the first breaking of the first drive. All right. That drive right there. So the mathematical calculation is up here, but the natural trend line is down here. So it starts to rally higher highs and higher lows, right? Definition of an uptrend, higher highs and higher lows. And then it pulls back and look right there. This is not a higher high. It's got a lower high. Can you see that? I'll make it bigger even. Boom, 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 boom. So that's a lower high. So we're getting a little granular in here. I know, but that's how it works. So you come in here and that's going to be A2. All right. It's the second opportunity for entry on the A drive. Now, it's still the A drive, that one big long A drive, but this is the A1. This is your first entry. And we oftentimes tell you don't chase A1s. Why? Because you get lots of false breakouts on A1s. We like to get in on A2s. Okay. That's this little one marker here. So you've already got a couple of drives. Usually we get 3 or 4. This one only had 2 before it fluffered and come back down and give us a lower high, lower high, lower high, lower high. And then the first green candle to make you a higher high. See that? See how higher highs work and lower highs work? Lower high, lower high, lower high. Turn, market broke on this one, broke above this one. We're now making higher highs. We're now back into the uptrend again. This is what we call a pennant formation. All right. Pennant formation, just like that, little pennant formation. But we're just going to draw our little trend like that. I like to call them shelves. All right. Usually shelves on the way down, but these are shelves on the way up too. So it come in here, you got the A2, and then it rises and it comes up here. And then look, boop, it fluffers again. Makes another fluff. 1, 2, 3. So it made another high, higher high, higher high, and then it made a lower high, and then it made a higher high, but then it made another lower high. And now it's right in here. And then first big green candle to make a new high above those right there. It's not as pretty sometimes. Sometimes it just fluffers around a little bit, but that's okay. We can deal with it. That becomes what? You label it. What label is that going to be? A3. So that becomes an A3. Now, why are we calling them these things? Why do we do this? Well, it's probabilities. It's all the probabilities. And it's like playing blackjack. You got to know what your probabilities are. It's like what cards are they dealing us? All right. So this is the cards they're dealing you. At this point, you have to ask yourself, well, I'm on A1, I've got A2, and this is A3. Now the market's taken off on A3. 1, 2, 3, 4, higher high, higher high, higher high, high. Lower high. What's the market going to do on a lower high? Well, it could definitely go up and break again. And sometimes strong markets do that. It could go to A4. It's really rare, right? The more higher you get, the less likely the odds are that you're going to get a continuation of the uptrend. You don't generally get A4s, A5s, A6, A7, A8, A8, A9, 9, 10. You can. The higher and higher it gets, the less and less and less the probability are that that's going to keep going up, right? Makes sense, doesn't it? So now what we're going to do is we're going to say, well, this could be an A4 if it breaks up and breaks above this high right here. But most of the time that doesn't happen. Doesn't mean it can't. It certainly can. I see A4s all the time. But usually the odd, oh, damn you, Lynn. I deleted all of them. Usually we don't see an A4. Usually we see this thing back off to what we call the delta cone of probability. All right. The delta cone of probability. So now what happens is we come down here and we draw a trend line up the natural trend line, just like that, right? Just like we did before over here coming down. Now we got a natural trend line going up. And so this is the top of the third drive, okay? The A3. It's that was A1, A2, A3. This would be A4 if it broke. So this is the top, this is the A3. So we're going to go back down here. I can't draw them all back in. It's a waste of time. So we're going to come in, that's the A3. So that means this is the top of the A3 drive. So what happens here is, generally speaking, it doesn't go to A4. So this is very much anticipated. So now you're going to go out and you're going to hear the news freak the funny out. You're going to watch the news go apeshit. Why? Because the market's going to go back to the one standard deviation. Now, is it going to do it here, or is it going to go up and do an A4? Could do an A4, but probably do it here. All right. So this is what we're anticipating. This is why these little lines are in here. These little lines, just like that, right? Anticipating it's not going to break it. If it does, it goes to A4. We'll put the same thing in there. We'll just readjust our delta cone of probability. But right now, our delta cone of probability is this little measured with this little tool here. We call it a Fibonacci ruler. All right. So it measures where the one standard deviation is. Markets like to go back to one standard deviation. And yes, I have a slide for that. All right. So I'm going to pull it up right here, and the slide is right here. Oh, that's not the slide. Yes, it is. It's right here. Len, your one standard deviation slide is right here. All right, there it is. Calculating the delta cone of probability, also known as the empirical data distribution rule. Approximately 68.2% of the time, markets stay within the one standard deviation of the mean. Now, I call it the delta cone of probability. The real name is the 68, 95, 99.7 empirical data distribution rule. I'm sorry, I can't say that every time. So I just call it the delta cone of probability. All right, so we come around here, around 95.4% of the time, it falls within 2 standard deviations, and nearly 99.7% of the time, it falls within 3 standard deviations of the mean. All right, so the mean is the dead center here. So we're going to say approximately 68.2% of the time, the market stays within 1 standard deviation. So if it leaves that 1 standard deviation, let's say it goes up into the 2 standard deviation, the likelihood is it's going to return to that 1 standard deviation. And that's what we're calculating here with the Fibonacci ruler. All right. The Fibonacci ruler has little markers on it that mark out that delta cone of probability. Okay. So here we go. Let's go back. Oh, they don't let me do that anymore. Now I have to remove this one first, and then I have to add this one in. They don't just let me flip it. Why? I don't know. I wrote him and asked him a question. I said, why'd you do that? Stupid. Anyway, nonetheless, it's not part of the lesson. It's part of my frustration. So here we go. So now as we come in here, and this thing is meant to fall back down to here. And if we have this little line here, see this little B line right there? That little line goes all the way across just like that. And you'll notice it's at 38.2. 38.2 right now is where that little B line is. Now, that little B line would be what we call a Fibonacci bow tie. So bow tie goes here, here, up to here. Notice it's at 90, not at 100. So it's still got some upside potential. And then it would come back down to here, which would be this one, not quite into the delta cone of probability, and tie off and give us that little bow tie. All right. Now, the thing is that it's actually more often we're going to see it go to the 100 or even 130.9. But if that's the case, look at how big that is comparatively to the bow tie. So not quite the way we would expect. It's kind of a funny looking bow tie. So we're going to come down here with it like that. All right. This pullback wasn't very strong. This market had too much strength. It didn't give us that nice bow tie that we like. It didn't come back to the delta cone of probability, did it? If we come in here, it didn't come all the way back down into the one standard deviation down here. It stayed a little high. Send it back. Let's see if we can grab this now. Nope. Send it back, send it back, send it back. Got all these layers. So this it came down to here, which was not even to the 38.2. So it stayed way above this one standard deviation on that first little run. But we're overall on the longer term trend right here with the ABCs and the A1, A2, A3. I am anticipating if this thing stays below that C point right there, it's going to come all the way back down to here. Now, it could be too strong to do that, and it might just come right back down to here or down into here, or it might even just come down to that natural trend line. See that natural trend line in there? And it might just stay above that natural trend line. We often say as long as the market stays above the natural trend line, just stay in, all right? Don't get out. If it breaks that natural trend line, well, you can get out if you want to or take some off. I like to take like 20% off when the market makes 20%. If the market makes 30%, I'll take another 20% off. If the market continues up and makes 40%, I'll take another 20% off. If it goes up 50%, I'll take another 20% off. I like to scale in and scale out, right? Just like the big boys do, accumulation and distribution. We talk about it all the time. And that's my little formula. And yes, of course, because I told it to you. Now I got to write an article about it in Pitt News Magazine, and it'll be there, not this month's issue, because this month's issue is going to come out probably tomorrow. That might be early because it's supposed to come out on the first Monday of every month, Pitt News Magazine. And it's got all these great articles this month. I'm so excited for you to have this one. I can't stand it. So I'll probably send it out early if I can get it out early. All right, if we can get everybody tied in and get it all done. It's not done right now. Today is the last day to work on it, and it's not done. So we're going to have to work on it really hard today. See if we can't get the Pitt News Magazine ready for you. What's Pitt News Magazine? I'm glad you asked. I'm glad you asked. I'm going to let Claire tell you about it this time, all right, if you don't mind. And then we'll come back and talk about the delta cone of probability and watch the news media freak out when the market returns to its Fibonacci ruler, one standard deviation.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pitt News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pitt News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pitt News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pittnews.com and subscribe today. Empower yourself. Enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.
All right. Thanks, Claire. I appreciate that. And this is what I expect the market to do. I expect it to flush back down in here. Now, is it going to do it on the A3? Probably. But it could go up to do A4 because we do have some upper side possibilities with the Fibonacci extension. So we got 100 here. It only went to 90 so far. We got 100 up there, and 130.9 is actually, believe it or not, that's a golden ratio to the upside. So that's actually the primary target for an upside market. All right, we like to see it go to 130.9 and then flush back down. So if it did that, if it went up to 130.9, we'd have to take our Fibonacci ruler, our Delta Kona probability measuring tool, put it up here at this peak up here. So we might get an A4 going up, right? Depending on how strong this market is. And then we would have this Delta Kona probability would be back in here. So then we would expect the market to flush from there down all the way to here. All right. Possibly hit 130, 38, 50, even 61.8 down in here, but probably somewhere down in this region here. So it's just if we go up there, and it probably wouldn't go that fast. I don't know. Since it's getting a little tough here, it might go right up here. It'd be out in here a little ways, and then it would flush out like that. Anyway, that's the possibility. But this right now, this is the probability. The probability is that it's going to flush back down right here. And we're going to see it fall back down a little bit, at least enough. We got to break those blue lights. That's the name of the game. So the game is it's got to break those blue lights, and those blue lights are going to start to accelerate. They're going to come in a lot faster. They can start coming up faster towards the end. So that's how that works. It's got to break that to get that first drive. Once we start and we get a little set of blue dots across the top, we'll get another set of blue lights going up, and that'll be the mathematically calculated drive. Okay. Now this tool, this bulls and bears tool, has been calculated, mathematically tuned in to that series of Delta Kona probability. So that's how that works. And that's what we're looking for. So when this market pulls back and hits back in here, and the reason I bring this up is because a lot of people are like, oh, I can't get into Palantir. I'm late. It's already up there to the top. But a lot of people like to buy really expensive stocks. Now, oh, it's breaking all-time new highs. I better buy it. I don't know who told them that. Buy a breaking of all-time new highs. You know who told them that? BlackRock. Why? Because they want to sell you the stock. They want you to buy it because they want to sell theirs to you. They don't want it up there. Hell no, they don't want to be buying high and trying to sell higher. That's really hard to do. They like to buy low and sell high. That's why I tell you, as this market starts to go up, you want to be selling off. Sell off 20%, sell off 20%, sell off 20% of your holdings. And then once you're down to about 50% of your holdings, then you start trailing up on that trailing stop until that thing gets stopped out. You take off the other 50% at the peak. You don't know how high it's going to go. So you might as well ride that 50% up until it takes it off. And then you take that off, and then it flushes back down, and you start putting it back on 20%, 20%, 20%. Once you get up to 50% back in, well, then you start trailing with your trailing entry, and you grab that whole 50% at the bottom, and you're back in full swing, and you go back up again. You take it off 20, 20, 20, 50, 50, 20, 20, 20, 50, 50, 20, 20, 20, 20, 20, 20. That's how you do it. Get rich, rich, rich beyond your wildest dreams. So you don't have to do that. You can hang on to it for a long period of time and look at longer trends. You don't have to look at the daily chart. Oh, man, I want to hold on to it for an entire year. Okay, well, hold on to it for an entire year then. And then you just look at the weekly chart or the monthly charts, and you just trade off of those instead of the daily charts. If you trade off the daily charts, well, you need to be taking profits off along the way. Well, I got to pay taxes. We talked about that yesterday. Okay, well, if you don't want to pay taxes, you don't want to have a taxable event, then let it just go up 10,000 and then lose all 10,000. Then you don't have to pay taxes on it because you didn't make it. How's that? That's a good plan, right? Let it go up $10,000 and then don't take your money because you don't want a taxable event, and then just let it go back down $10,000. Now you don't have to pay taxes. That's a good idea, right? That's a great plan. Don't pay taxes. That way you don't have to pay taxes. You also don't get to buy a new Tesla either. All right. So that's how it works. Okay. So that's the plan. And so watch the media freak they're going to blame Trump. Trump's, his tariffs aren't working. He can't get anybody to, China's doing this. Oh, his tariffs, he can't. Oh, they're going to blame everybody. And of course, they're not going to blame anybody but Trump. It's all Trump's fault. Everything's Trump's fault. Okay, so that market, if it just makes one little down day, Trump's, but that's how markets work. They move in waves and patterns, and it's all because of mathematical models and quant style computer trading systems. And that's what Pitt News Magazine is all focused on, this issue coming out hopefully tomorrow, maybe the first Monday of every month, but maybe tomorrow if I can get out to you early. And It's all about the quant system, about Aladdin, which is BlackRock's mathematical trading system. All right, so that's Palantir. And again, the other reason I bring this into you is because if you come in here and you run this out like this, and you look at Palantir, you're like, oh, doggone it, I missed my opportunity to get into Palantir. I should have got in down here when Land said to get in. But I didn't trust Land. Who trusts Land? Nobody trusts Land. Oh, I guess you guys do. That's why you're here. So you can learn how this is done. So I said to get in down here, right? And so lots of guys did. And so that's what's happening. And now people are looking at this and saying, I wish I would have got in Palantir. The point I'm trying to make is this baby's going to come back down here. Probably. The odds are it's going to come back down at least to this level here. All right. At least to this level here. So you haven't missed it. You're going to get an opportunity to buy some Palantir down here. And you're not going to do it. You know why? Because I know people. You're not going to do it. Why? Because you're going to say, it's coming down, Land. Oh, no, it's just going to keep on going. It's going to keep on going. I don't dare buy any because it's just going to keep on going. And then I'm going to lose everything I put in. That's the feeling that you're going to have inside of you. I can't buy it down here. I got to buy a stock that's doing well. Okay, so that's what you do. You come in, you say, okay, how much money are you going to put in a Palantir? Okay, I'm going to put 10 grand in. So what you're going to do is you're going to come in and you're going to say, when it falls 10%, I'm going to add 20% of my 10 grand. Okay. And then when it comes down another 10%, you're going to put another 10% and another 10% and another 10%, or you can do 20%. So you're going to put in 20% and then 20% and then 20%. All right. And once it gets down here, you're going to start trailing with a stop. And at point, you can either use the yellow lights or you can use the blue lights. And when it crosses those little yellow lights and you do 1-to-1, or if you cross, you can turn those on. See little yellow lights just like this. Parabolic SAR. No, ATR. There it is. Okay, so when it crosses those little yellow lights coming down the other side, you can put in the rest. All right. Now, it might be premature. Sure. Don't put it all in. Put in, 90%, 80%. If it breaks and comes down again, then you still got 10% on the sideline. You can, if it goes up 10%, you can add your 10% in. And then you want to start, as it starts getting up, you start taking it back off again. I want to stay in longer, Land. Okay, well, then stay in longer. You don't have to sell it off. I'm just telling you, I think you're going to have an opportunity to get in as this thing pulls back. How far is it going to pull back? Nobody knows, but we can make a pretty darn good estimate. We think it's going to come back into this region here. And so if it does, and it might be too strong to come back there, it might only come back into here. But if it does, you want to start putting your 20% in so you can get some of your money in, dollar cost average on the way down. Your big chunk's going to be down here when it actually turns and bring that whole dollar cost average down. So you don't miss it if it does make a shallow return. If it just makes a shallow retracement, starts going up, at least you can have some money in there. All right. But if it makes a shallow retracement and doesn't come down and break those blue lights, well, that means that you're going to have a bigger retracement up here. All right. Because it's got to break the blue lights eventually. Does it have to break the blue lights, Land? What if it never breaks the blue lights? Well, that would be unprecedented, because if you go back in history and you look at the full Monty, it's always broke the blue lights. Every single frickin' time. There's not been a time it hasn't broke those blue lights. So that's what we're waiting for. Look at that. Every single time, not a time in history has it not broke those blue lights. So that's what we're waiting for. Just wait for it to break the blue lights, and then you can get in and get the next rally. Okay. All right. Let's go look at some options. I promise we look at some options. I've been playing with the options quite a bit. All right. So I want to pull up. I've just been goofing off with them, putting them in, seeing what they are. We're going to do some poor man's covered calls. I probably way overloaded on options, but that's how you learn, right? You come in and you buy a whole bunch of them, as many as your account can afford, so that you can learn. That's how you learn. So you got lots of examples all running simultaneously. And then you see which ones worked and which ones didn't, and what you can do and how you can adjust, and how you work with one that's not working and how you work with one that is working, and you can get your education going a lot faster. Remember, this is an education site. I'm a university teacher. I teach at the university. So that's what this is. It's the lab, and that's how we learn. So when you see an $8,000 loser, you go, oh my gosh, Land, you got an $8,000 loser in there. What are you going to do? Well, we got to figure out what to do. We didn't make a mistake. This thing looked like it got a buy signal right here on the little red arrow, and it just fluffered down. So that was a bad move. So what do? We got to adjust. We got to figure out what to do, because this is going to happen to you in the real world, in the real life. You got to know what to do. Well, it's an opportunity for you to sell some more premium, make some more money. Look, we sold this one here, and we're getting $2,000 off of it. We paid $25,000 for this one. And the reason I did that is because SMC's Super Micro has really good options to trade. I love the Super Micro options. So I thought, well, this is a good opportunity for us to trade lots of options. I didn't expect it to flush right there. That was a big flush. Not too concerned about it. Look, we got $2,000 right here. We can make it up. This is 324 days. 324 days. And I'm selling premium out here at $2,000 a whack. 16 days, I'm going to make $2,000. I can pay off that $25,000 really fast if I can do that. All right. So I'm not too worried about it. It's only down 6,000. We're already making 2,000. All right, let's go. This is the 100% club. So this is all the companies that have made 100%. See, they're all fluffing back down. So that's what I expect Palantir to do the same thing. I think they're all going to have this little pullback. See that? Every single one of these things are starting to pull back today. This is anticipated. This is normal. This is not out of the unusual. This is right what we expected, right? So don't freak out. Gives you an opportunity to get in. So let's come in here. We're going to go new, and I'm going to say this is our class options portfolio. All right. So now we're going to come in here, and I'll show you a neat little trick. We can come down here to our accounting. Look at how many options I put on. I've loaded this up for bear. We'd be doing pretty good if it wasn't for that one SMCI that I put. Or no, it was SMC. Yeah. If it wasn't for that one, $8,000 loser, we'd be doing all right. Well, we got another 2,000 down here. Watch this neat little trick. I've got a new portfolio up here. I'm going to open up all these into it. So I just go Control A, selects all of them. I right click on one of them and say Open Charts, and bam, 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 opens up every single one of them that's in my account, and it opens them all up. All right. So now we can come in here. We're down on every single one of them. Which, surprise. It's okay. It's early in the day. It's early in, oh my goodness, look at that one. XLE. That's the energy sector. That's flushing. Of course, we should have known better, right? That's an X1SA1. X1SA1 has a probability of rising on an X1SA1 by how much? X1SA1 has a probability of being 25% chance that that's the bottom. And we bought a, did we buy a call? What did we do? We bought 5 puts. Oh, we bought 5 puts. So we were smart. 25% chance that's going to rise. So we bought some puts and down it flushed. All right. Smart move, Lan. Okay. XLB. We did the same thing. We're expecting a flush on that one too. So we bought some puts. And SMC, we bought calls on this one. I was looking for this one to make a nice rally here. But it's probably going to come down now. If it's going to come down, we got this little marker here that we got to break. Look, it's breaking the blue lights to the downside. That's not good for SMC. We got all these little markers down here that we got to be careful of. But that's okay. We're not going to be worried and nervous about it. Why? Because we can make $2,000 roughly $2,000 every 16 days on this market. And so we just have to let that one pay off. All right. Not too concerned. NVIDIA, we bought some on NVIDIA just in case it wants to rise. We got this one here. This is an annual, right? So it's like, where do you think these markets are going to be in a year? I think they're going to be way higher. But we're coming into a little triangle formation down here. It's our natural trend line. Is it going to respect it and stay above it? Nobody knows. It's got that blue light looming down there. Remember, break the blue light. If it breaks the blue light, down it goes again. But this is 3 drives pattern. This is drive 1, counter trend, drive 2, counter trend, drive 3. And so this should be the bottom. Can it go down and make a 4? Certainly can. If it does, we'll just play it that way. The problem is this is down today. How many of these do we have? How many did we buy? We bought 5 of them. Let's come in here. Let's go to our options. Go out 16 days. And what if we sold a call up here? How much could we get out of it? $153. That thing looks like it wants to go. $200. We could do that. Let's go see how much volume there is. 16 calls. And we're getting, oh, look at that. Very nice. Very, very nice. A lot of people are doing this one here. We don't want to be that one. We want to be one above it right there. Yeah, baby. $235. And we're going to do how many of them? 5. 1, 2, 3, 4, 5. All right, we're going to sell those and we're going to collect $1,177. Go ahead and knock that baby in. So we're going to sell at 234. We got to go to 235. Well, maybe. Let's see. Place the order. Yes, sir. We just got it. $1,180. So we'll see how that plays out. All right, let's go to the next one. SMC, we already did. XLB, that's a put option. That's a put option. Microsoft. We bought a call right here. Dumb place to buy a call. Let's do it anyway. 16. We're going to come in here and go 16. And we're going to come down here and we're going to sell right there. That's a little high. That's not bad. $682. That's, see that, 471, 3,000. We're going to go one above it. All right, we're going to go one above it. Why? Because markets like to go up and test all those guys and piss them off. And then if it does, then we'll just be one above it and it won't piss us off. So we go just one a little bit high above it, but it goes from 592 to 682 to do that. So if you go down here, you make a lot more money, but you also have the chance of getting touched because they like to go where everybody is, scare everybody out. So we go one above it, and we'll just do that. All right, how many do we get? We got just one. Is that all we did? Well, that's sad. That's a disappointment. Why'd you only buy one, Lan? Because it was on its way up. All right. Really? Just one? All right. 585. So, oh, $6. $6. 605. Ah! Okay, place quick. All right, we got it. We got our one. $605. Can't complain about that. All right, let's go to, oh, that one's already done. We've already sold 3, 4. We broke those apart. So we got 3 up here and we got 1 right here. This is VTAI, whatever the heck that is. All right, so it's got our arrow. Then it's breaking back on the arrow. That's okay. Cisco. What are we doing on Cisco? Cisco, we bought how many? 1. Yeah, onesies. We're just playing onesies right now. So how can we sell 16 days? Not going to make very much money. Let's come in here to our options table. We're going to sell one right up here, $142. It's better to stick in the eye. $100. Let's see, what's that going to look like? That's not good. We could go right there. 16 days. That market might rally up over that. We go up here, but that's only $43. It's like a why bother? That's a why bother, my friend. We could go there. That would be the Fibonacci bow tie, $93. Oh, we got one of these things on Cisco. Well, it is its second drive down. It's coming into, let's draw our trend line in there. Just like that. That's our natural trend line. Could make a third drive down. Who knows? Let's go ahead and sell this off. 85 cents, 94 cents, 94. Place that order. There it is. We just got ourselves $94. All right. So let's come back over here. Salesforce. We got a long call. And we're going to have to come in here to the option. Let's sell one off. 16 days. We could come in here and you know what? You know what we could do? We could play a little game. Let's go play a little game. You like playing games? I like playing games. Play games with the market. It's what it is. All big video game. All right. So we're on the third drive down. That was almost a full reset. That looks like a full damn reset to me. Look, 3 drives, drive 1, drive 2, drive 3, A, B, C, flush. I think we're down here. I don't know. We could get one more. Nothing says it can't go down one more. So let's sell something right here. Okay, we're going to sell a call right up in here. How does that turn out? Let's see on the table. Ooh, we'd really like to be above that one right there, but that's only $143. How many do we have? 1. We're doing a onesie. Okay, we're going to bring it down here. 457. Oh, What if it goes up, Lan? Well, you have to roll it. But look, that's, oh, 0. But look at this one here, 2,000. Let's just do something good for ourselves. Not worry about what everybody else is doing. I think that's probably a little bit better move. Maybe that one right there. 18, 20. That'd be an A2. Okay, let's just do that one. It's a little more conservative. You could just put it right at it. We got to go down here, get a little bit more money. 365. Let's do that one. We'll be a little bit more aggressive here. Okay, so we got to go down to 355. 355. There we go. Place the order. And we just sold another call, picked up another $355. Let's go out to our charts. We got BMI, Bristol Myers. You are the one that's causing me stress. But we only did one. Call, buy 3. Oh, wait, we got 3, 4. Call, sell. Oh, one's a sell. So we did sell one, but we got, wait a second. Why are we only selling one? Oh, wait a second. I got sell a put, sell a call, buy a call. We sold a put? Where did we sell a put? Oh, this was the game I wanted to play. We did sell a put down here. Oh, we're smarter than the average bear. Buy a call, sell a call, sell 2 puts. We're only selling one call against our three that we bought that we called. What are we doing? Man, you can sell 2 more. You can sell 2 more calls up in here. Yes, you can. How much you gonna make? Let's go see. Oh, let's see. Sell those down here. Oh, geez. What are we doing? $42. My gosh, why did we even get into Bristol Myers? Get out of this stupid market. The options aren't worth shit. Why did we get into Bristol Myers anyway? Didn't even wait for the market to come down and break the blue lights. This is a dumb move. Spread. 2. We got to go to 41. Are we doing 1? How many we got? We can do 2 of these, right? Am I right or am I wrong? Because we're long 3. Oh, no, we sold 2. Oh, wait, that's a call. That's 2 there. How many did we buy of these things? We bought 3 Bristol Myers. We sold 1 call. We can sell 2 more. Not like it's going to make us any money. Why in the heck are we even in this stupid market? What were we thinking when we did this one? I don't know. Anyway, can't remember. The options suck on it, though. Let's see. AMD. What have we done here? We bought a 324 and we sold a 16. So we already taken care of that one. We've done 5 of 5. All right, that's our options table. We gotta put this into a spreadsheet. I wanted to show you my new spreadsheet that I'm working on. All right. Jay says Tesla paid 66 cents this month. Ooh, we should have done what did we say? I think we said 50. We did ours. We did our math on like 50 something, right? I don't know. Anyway, much better. Tesla, way to go, Tesla. I think that's better, right, than what we did our calculations on. All right, let's come in here. And I wanted to show you something. Before I show you, I want to show you something else. I want to show you, before we go away from here, I want to show you the software that I'm using. A lot of people want to know the software I'm using. For those of you who are new, the software I'm using is Track and Trade. We're using the stocks version here for the options. You can do the drag and drop options like we did. It's really nice. So that's stocks chart version, blue version. Go get it, trackandtrade.com. Then come and join us. Sign up, subscribe to the channel, follow along. and you can do what we're doing. Now this is a class, so we're learning. So you can practice, practice, practice. We're going to do all these, and then we'll discover which ones are good, which ones are bad. The ones that are good, we can take those good ones and we can go take them into the real market, right? That's the idea. Okay. So come and join us, get your software, and subscribe to the channel. All right. So let's remove that. How do we get rid of it? We got to remove it. Then we got to put it back. Okay. So now I want to show you my spreadsheet. I want to show you my spreadsheet. I've been working on my dividend spreadsheet. I probably should have showed you this back when we were looking at dividends, but I wanted to save it for you. My killer UBI spreadsheet. Where is it? Okay. This is what I've been working on. Now you guys can take this model and redo your own if you want, or you can wait for me to finish it and then I'll give it to you. All right. So this one, you'll notice it's way different than here. Let's pull up the UTU dividend spreadsheet. Did we get any dividends that we have to count? How come that's not opening? There it is. It's being slow and stupid. Okay. This is our normal spreadsheet, right? I mean, it's all spread out. It's all messy, all this columns and all these tables and everything. And it's just not, you want to do one thing and you have to go way up here. You want to do another thing, you have to go way down here. This was just my first attempt. Actually, it's not my first attempt. It was like my 10th attempt. I created this thing. And then I made another one and I said I was going to send that one out to you. And then I didn't. And it was even cleaner, a little cleaner than this one. But then I got another wild hair idea. And so this is the one we're working off now. I think we have actually, did we do, YMAG gave us a payment on Friday. Did we put that in already? I think we already did. Let's go look and see just to make sure. YMAG April 1, 2, 3, 4. Yeah, we've done all of it. So we don't have any more money coming in until next month. I think we look at this. We got paid out $6,000 this month on our $170,000 investment. So we put $170,000 and we got $6,400 back for the month of April, which was better than last month. March was worse. It was $5,700. We got $6,400, but February was $7,000. January was $7,000. So May, what's going to happen in May? I think May is going to be a better month. I think May is going to be better, back up probably around closer to, and maybe because we've actually put more money back in, we might be better than 7. I'd like to see us beat January in May. That would be cool, right? All right, because we're not sliding straight down like, down into the depths of hell. Is that market flushed like a toilet? All right, so I wanted to show you my new model. Here it is. So this is the one I'm working on. Now, the idea here is that it's all consolidated. So you see we got the name of the stock up here. We got the current price. We got the average cost, share quantity, dividends. Most recent 533 total yield is 102. We got all the dividends that it's paid out and how much money we've invested in. So this is my real money one. This is what I'm really doing right now. So I've got total dividends, $15,000 in dividends. I got $113,000 in there and seed. So, that's the date. The current value is 113. The seed, I put in 113. I'm not sure if this math is right. I think it is. Total return is 129. I've had $15,000 in dividends. That's a 14% ROI since I started doing this in December. So in 3 months, I've made 14% on my money. That's pretty good. The dividends have kicked out 14%. By the end of the year, it's supposed to kick out 102. The whole total yield is 102. So see, everything's right here in this one little box. So I don't have to go jumping all over the spreadsheet. And I'm going to do this for every single one, but I'm not sure the math is right. And I'm not sure the layout is exactly how I want it. Because we have to have these in a row. And then these will have to all add up for the total portfolio across the bottom. So I'm still working on it, but it's an idea. It's an idea. And how are you going to get this idea? Well, if you're a subscriber to Pitt News Magazine, you get it for free. Right? I give these spreadsheets away for free to anybody who's a subscriber to Pitt News Magazine. So if you want these spreadsheets that I work on, you can have them. Just subscribe to Pitt News Magazine. All right. So that's it. That's what I got there. That's what I got here. And that's something you can look forward to. And hopefully we can look forward to rising markets Happy days, not SMCI. That's a sad, sad state of affairs. And flushed out already. And then when we get our little pullback on PLTY, if you want to get into some, this is your opportunity. I think this is going to be your opportunity to get some PLTY if you haven't got any yet. All right, guys, that's it. That's all I got for you today. If you had fun today, like, share, and subscribe. It's always nice to go out. If you had fun, put a little comment out there and say, had fun today. All right. And that's always good to see a comment or two. Put your little thumbs up. I always like thumbs up. And today is, what's today? Tuesday, right? Oh, today's Wednesday. So tomorrow is Thursday. Tomorrow we do day trading. Next week, starting May, the first week of May, starting the 5th, we're going to change up it's going to be the summer schedule. All right. So summer schedule, we're going to be doing Tuesdays, Wednesdays, and Thursdays. We're not going to have class on Mondays and Fridays. It's summer. We got to take a little bit lighter schedule. All right. So Tuesday morning, we'll do stocks. Wednesday, we'll do day trading. And Thursday, we'll do stocks again. So we got to stay up with our options classes and with our day trading class and with our UBI dividend class. And those are the three things we'll do each week. So Tuesdays, Wednesdays, and Thursdays. So Tuesday morning, Thursday morning, Wednesday afternoon. That's going to be the summer schedule. All right. And then when school starts again in the fall, we'll go back to Monday, Wednesday, Friday again. All right. Does that sound good? 3 times a week, we can all get together and review our portfolios together and do a little day trading on Wednesday. All right, guys, that's what I got for you. If you have any questions, please let me know. And we'll look forward to a nice summertime with a, they always say sell in May and go away, but we want to be a little more cautious. We're going to keep our portfolios going with that UBI, universal basic income, so as we can have some income through the internet, through the summertime. We don't want to sell in May and go away. We're going to still stick with it. All right. We know things might be a little lazy, but that's all right. That's the nature of the beast. All right, guys, we will see you tomorrow afternoon for some day trading.